Hi, I'm Chun Beng. Together with me is Chupan. We are from mykayaplus. So we have decided to work out a series of video during this lockdown period. And the first topic that we want to share about is PE ratio. Chupan, do you want to start off with the definition of it?
Sure. So PE ratio is the most common term we come across in our investing journey. So in very layman terms, if you buy a stock at RM10 while the company is just earning 1 ringgit, the PE ratio is 10, simply by using the stock price, which is RM10, divided by the earnings, which is RM1.
Yes, in another word, if the company continue to make RM1 every following years, we are going to get back our investment in 10 years. Then probably a lot of people who are new to investing will ask, how about those stocks that are traded with PE ratio of 50 or even 100? Is it means that we need to wait for 100 years before we can get back our investment?
Yeah. So there's a reason why sometimes people are willing to pay a high price for a stock. So yep, you're right. If a company continues to earn 1 ringgit every year, definitely you will need 50 years to get back your investment returns. But if a company can earn more than 1 ringgit the following year, then the PE will be normalized and becomes reasonable.
Yes, as a layman, then probably the next question you will ask is like the slide there is, how do you know a high PE ratio is justifiable and logical? On this, our interpretation always comes from the denominator of the formula, which is earning per share, as the price is something we can't tell and is always driven by the market.
Yep.
So we will suggest when you're doing stock analysis, you should always ask yourself two questions. Chupan, maybe you want to start off with the first one.
Yeah, absolutely. So the first question that we want to ask whenever you come across a high PE stock is whether the growth is rapid yet sustainable. So in very simple terms, if the stock is going to achieve higher and higher revenue the following years. So if yes, then will the profit also follow? So because revenue is directly proportionate to the earnings, when the revenue is high, the earnings will also tag along. So one good example of a company that actually exhibit this is GoPro. Are you familiar with this company?
Yeah. I think a lot of you also probably will be familiar with this company. In simple terms, it's a company that manufactures a lot of good wide lens adventures cameras. I would say when they first launched, based on this graph, it was quite good at the first place where people are fighting to buy the stocks.
Yeah. So, but what happened after that? Sales eventually hit a threshold, and even though they really made good cameras, the upcoming and future models just did not have any much additional specifications. So from the graph, you can see that once the sales actually hit a ceiling, then it started to drop down and normalize, and the share price also was affected.
Yes, so probably the next slide, you will see how all these are relating together. It's quite clear that if the company is purely riding on potential high revenue growth in coming years, like GoPro, the high PE ratio cannot sustain, and eventually it will collapse when the revenue hit the ceiling. So as a smart investor, of course, it is still a good investment if you are able to realize the profit before it reaches the ceiling. We wanted to share some good example beside GoPro is one of the popular stock at the moment, which is revenue per heart. You can also relate it with the GoPro case because right now they are on a very early stage and they get popular. People start to chase for the stock and causing it having a very high PE. And maybe if you're not familiar with revenue per heart, basically they are selling payment gateway machine and they are really new to the market, and I believe they are only covering maybe a very small part of SME. So it seems to be a very good stock to invest in right now. But when we want to analyze stock like this, early stage, high PE, high potential, how should we analyze?
Okay, you're right. Revenue Berhad is involved in selling payment gateway hardware solutions, but they are just very, very focused in Malaysia. And one day, it will hit a threshold when the market becomes saturated. At that time, if the PE is still very high, as investors, we should take note whether is it a good time to realize any investment gains.
Correct. So take revenue as an example. Is if you just relate their growth, is directly related to the number of SME in the market. So let's say now they are capturing 10% of it. So probably when they hit about 80%, you should basically realize the profit before it hit the ceiling.
Yeah.
In simple term, maybe we can summarize in this way. If you're going to buy a high PE stock, revenue only, like the GoPro case, you need to have an exit strategy when you pursue it. You need to know that this stock definitely will have a threshold, and you should basically realize it before it hits that. But then come back to revenue case, is quite different with GoPro, as they are not only basing off the payment gateway machine, they are also having some recurring income.
Yeah. So as you mentioned, besides having a very high revenue growth by gradually, slowly selling their payment gateway machines into the Malaysian SME market, of course, the recurring revenue that they earn from the credit card swipes will also complement their future revenue portfolio well. So, but moving onwards, apart from just looking at the rapid revenue growth, there's another question that you should ask yourself when you look at the IP company and is considering to actually invest to it. So the next question would be, is a company a monopoly that is having a huge profit margins, a potential, a valid reason to actually buy a company at a relatively higher PE?
Any good example of this kind of stock?
Yep, of course. So I guess everyone should also know about this company. This company is called Facebook. And do you know that Facebook is a monopoly?
Yes. I believe every one of us have this app at our mobile phone. We will open it at least few times per day.
Yeah.
We can say they are the king of the social medias.
Yeah, exactly. So, but the Facebook that we are using now is very different from the Facebook that we used 10 years ago. So at that time, it was purely a social media app where we used to keep in touch with our friends, view photos, and also watch a bit of videos. But as of now, since their user base has grown so much, they have turned into a very lucrative advertisement space. So with more and more ads popping out also, so even though when you are scrolling through your Facebook wall or even watching videos, and we can see that the business is very lucrative because they are earning 30 to 40% of net profit margin on their advertisement business.
Yes, so you can see that Facebook is a very good example that it's a company with a very good business model, and this will actually help them to sustain a high profit margin that can actually justify their very high PE during the IPO time.
Yeah, exactly. So when you look at Facebook price and PE ratio movement historically, it's very different from GoPro. So imagine if you are smart enough back then and you did your research and you decided to buy Facebook due to a huge room of profit margin potential. And the right movement is eventually that once the earnings from the advertisement business kicks in, the PE actually normalized down from 100 during IPO to around a region of 20 as of currently.
Yes. So in short, what we're trying to say here is when we look at high PE stock, we should definitely study their business model and try to understand whether they have a chance to monopolize or at least have some sort of unfair advantages to allow them to boost their margin over the years. This
Yeah.
would give a good indication whether the high PE is reasonable or not.
Yeah. So before we end our sharing today, remember to always ask yourself when you want to look into investing companies with relatively high PE. First, is the company going to have higher growth in terms of revenue, and is it going to be sustainable? Or is the company having such a special economic mode or advantage that allows them to call the shots in terms of pricing and hence having very, very high profit? So only if one of these criteria or both of them are available, so only then you should put this company into your watch list and buy them at the right time.
Yes, I think this concludes what we wanted to share today. Hopefully, we share something useful for you. We could leave your feedback or question at the comment section. If you have specific topic want us to cover, just shoot us the request. Don't be shy.
Yeah, and don't forget to like and subscribe. Yeah.
Yep. So see you next time.